Greg, it's great to see you as always.
Always a pleasure.
Man, I could use all of the words this morning that I've been hearing: confusing, murky, foggy. Take it with a grain of salt. Those are some of the things I've heard you describe this morning's CPI report. What can we say about the report? What did it tell us?
I call it a Swiss cheese report. It's full of holes. We're missing a lot of data across the board. The main message, in my opinion, is the following. One, we have still a gradual pass-through of tariff cost onto CPI inflation and consumer prices. If you look in particular at the category that I focus a lot on these days, which is core commodities prices, core goods prices, when you exclude energy and food, that's rising at a 1.4% clip. That category usually deflates over time. It falls over time. So there is a pass-through here effect of the tariffs. On the opposite side, you have services less energy that are showing disinflation. These prices are rising, but at a slower pace, and that pace is about 3%. Now, it's twice as fast as goods prices, but it is revealing this deflationary trend whereby prices are rising, disinflationary trend whereby prices are rising at a slower pace. The key reason for that this month was that shelter cost disinflation is gathering pace. I'll put a big caveat there, as you just said. This is extremely noisy, and I think the shelter cost disinflation may be somewhat overstated by the methodology that the BLS use in the absence of October data.
Yeah, and that's something I've definitely been seeing a lot of chatter about this morning, Greg. When it comes to prices, obviously this is something that is really weighing on consumer sentiment. We see that reflected in surveys here in the U.S. And of course, the president spoke last night. He talked about prices. He addressed the issue of affordability, and he talked about bringing prices down. Now, you're an economist who has watched this stuff for a long time. What levers does the government have? And let's put aside the Federal Reserve for a moment. What levers does it have to bring prices down, or, to at least create disinflation, let's call it?
Yeah, so I think you're very right to point out that we do not want to see deflation, which is falling prices, because generally speaking, falling prices accompany a recession or a depression. So we don't want to be seeing that. What we want to be seeing is essentially an environment where most households feel they're able to spend, and that the affordability crisis that has been brewing is becoming less of a constraint. Now, there are two elements to an affordability crisis. We were talking a lot about prices and cost. The other element is essentially wages and salaries. If you have the wages that are rising faster than prices, that means that people have the ability to spend, even if prices are somewhat higher. And that phenomenon does not happen overnight. It takes time for essentially any type of real wage increase to gather momentum and allow for this affordability crisis to become less of a constraint on households around the country. So the answer to your question is that there isn't a simple lever that the administration can pull apart from one specific thing. Alleviating some of the tariff cost pressures would reduce the pressures on many businesses and reduce the incentive to pass on those higher prices to consumers. That is the key lever that can help alleviate some of these pressures. But in the broad context of all of the inflation we've seen since the post-COVID period, which is accumulating to about 25% since 2019, there isn't really a key mechanism to alleviate this affordability crisis.
It's more that people maybe just have to get used to it over time and make more, to your point. Let's talk a little bit about next year, because I think your note looking ahead to 2026 is interesting. You talk about three resilient but narrow pillars for the U.S. economy that are sort of delicate, right? That they're fragile, if you will. And these are the three that you point out, but walk us through this and why they're fragile.
Yeah, I call them the A pillars of growth, narrow foundation to economic activity. And the A pillars are: 1, affluent consumers; 2, AI investment; and 3, asset price appreciation, stock market gains. Now, they're creating right now a virtuous cycle, because we essentially have affluent consumers who are spending in part on wealth appreciation, which is driven by stock market gains. You also have greater optimism about AI, which is leading to a lot of CapEx and OpEx investment in AI. which is also leading to stronger stock market valuations and feeding back into investment. You can see how this is all intercorrelated and leading to stronger growth in the US despite a number of headwinds. But there is also the risk that this turns into a vicious cycle. And I think that is really what we have to be very careful with in 2026. The risk of perhaps an AI-related bubble that might burst could lead to a stock market correction that leads to a negative wealth effect and a negative confidence effect for families across the country, leads to reduced investment and reduced hiring in a labor market that is already softening. Those are the potential risks to this economy. So yes, it's great to have this AAA pillars of growth that are supporting economic activity, but they also represent a narrow foundation, which is where we have to be very careful and attentive to potential downside risk.
So all of that said, you're looking for 1.9% growth in the U.S. next year, which is roughly on par with the growth that you expect to see this year. So while you say it's a balancing act, right? It sounds like you're at least cautiously optimistic that we're gonna make it. We're gonna achieve that.
I think we will see average growth around potential next year, but it will be supported by this narrow foundation to growth. We will see consumer spending essentially at a moderate 1.5% pace. We will see greater investment in AI connected areas, not just those big players that invest in AI, but any firm that is leaning towards AI with a holistic strategy, with essentially the aim of integrating AI into their strategy, those segments will see stronger growth. But I think the defining characteristic of our outlook is actually greater polarization within economies around the world and between economies around the world. You're seeing the well-offs and you're seeing people with more funding abilities that are doing most of the spending. You're seeing businesses geared towards AI doing most of the investment. You're seeing stock market prices that are tied to AI that are seeing most of the gain. So we're still going to see more polarization, and I think that will be a defining characteristic of the outlook in 2026.
Greg, good to see you. I'd love to
Always
dig
a pleasure,
more
Julie.
into that last point the next time we talk. Thanks.